PwC Kenya, in partnership with Kenya Bankers Association, has released a report on total tax contribution of the Kenya banking sector. The report, which is one of the first of its kind in Kenya, outlines the tax contribution of the banking sector in forms of taxes borne by the banks, such as corporation tax and irrecoverable VAT, and taxes collected as an agent of government, such as pay-as-you-earn, excise duty, and withholding tax. The report covers the 2017 and 2018 financial years and involved 38 banks and microfinance institutions, which made a total tax contribution of 108.1 billion Kenyan shillings and 99 billion Kenyan shillings in 2017 and 2018 respectively. This demonstrated the critical contribution of the industry to taxes. Titus Mukora, tax partner at PwC Kenya, said the purpose of the study was to quantify the tax contributions and draw connections between taxes and economic developments, such as the interest rate caps and adoption of technology by banks.
Report. So apologies if I go quickly. I'm not trying to pull the wool over your eyes with some statistics here. Just trying to just bring out the key messages. So I think everybody who's spoken before me has kind of given an indication of why what the importance of this report. And maybe this is the first time that we're sort of gaining a holistic understanding of how taxes operate within the banking sector. We also getting to understand how industry-wide trends have affected taxes in the industry, and also how the taxation policy is actually affecting the industry, and just looking at whether there have been some sort of distorting effects of taxes on the banking industry. This methodology is a methodology that's designed by PwC UK, where the total tax contribution team sits. The importance of having a consistent and standardized methodology is so that you can actually be able to do comparisons with other jurisdictions. The data was collected over 5 weeks for the years ended 2017 and 2018. And 38 of the 44 banks, representing about 95% of the market share, participated in this survey. We also cross-checked that data with information that we got from the KRA's risk and research team, just to validate some high-level numbers that we were getting from the respondents. And some of the key industry issues that were present in 2017 and 2018 were the 2017 elections. And I say elections with an S because there were 2 elections in that year. There is a fiscal deficit, and so there is a concerted effort of reducing the fiscal deficit. Banks in 2017 contributed 108 billion to the Kenyan exchequer, and in 2018, 99 billion, giving a total of 207 billion. And those, again, if you divide them between taxes borne and taxes collected, is 110 billion for taxes borne and 96 billion for taxes collected. You will see with taxes borne, there was a very significant decrease between 2017 and 2018 from 62 billion to 48 billion, and that was driven by a decrease in corporation tax. So 81% of taxes borne by banks are represented by corporation tax. There was a reduction of corporation tax from 84% to 79%. That was because 2017 was the first year that we had a full year of the interest rate cap regime. 2017 is also when we had the 2 elections. So there was a huge overpayment of corporate taxes in 2017, the impact of which was felt in 2018, and hence the reduction of corporation tax in 2018. As a proportion of taxes, irrecoverable VAT rose, and primarily the rise in irrecoverable VAT was more due to the reduction of corporate tax, and therefore the percentage of irrecoverable VAT increased in 2018.
According to the report, in the 2 years, banks contributed a total of 207.2 billion Kenyan shillings in taxes. However, there was a decline in tax contribution from 2017 to 2018 attributable to reduction in taxes borne by banks and in particular a reduction of corporation tax paid. This was as a result of low profits reported in 2017 and relative to 2016.
Which is approximately more than 70% of the total banks that operate in this country, show that banks make a very significant contribution in terms of taxes that they pay and collect, in excess of 100 billion for both years, essentially. The increased understanding will really inform policy decisions that impact this particular sector, especially from a tax perspective. Total tax contribution.
The decline in taxes arising from declined profitability in 2017 is reflected in the reported year-on-year decline of the industry's net income for the period 2016 to 2017. This is also reflected in the decline in growth of net assets in the sector in 2017 of 6.8%, down from 11% growth in the previous year.
Refers to the taxes borne by the banks, such as corporate income tax, a recoverable VAT that is actually paid by the bank themselves or in their own capacity, but also the taxes that they collect as agents of the government. So our fervent hope is that the evaluation of the banking sector from a total tax contribution perspective can lead to more informed decisions. There's the fast-paced technological changes, some of it captured by the move away from the brick and mortar distribution channels to the more technologically enabled channels. We are aware that banks are heavily focused on their cost to income ratios, really in an attempt to increase the returns to shareholders. We are very much aware about the interest capping that is constraining banks and creating a credit squeeze on borrowers. So it's really important then for the total tax contribution by the banking sector to be evaluated in the context of their operational environment.
Bankers Association CEO Dr. Habil Olaka, while speaking during the launch, said that they were pleased that PwC has underscored their findings from KBS internal review.
Provided the market with an in-depth view of what was driving the industry growth and development. On the other hand, the shared value report provided our stakeholders with a glimpse of the many ways that banks create economic and social value in the society. Therefore, when PwC proposed this study on how banks perform as corporate citizens from a taxpayer's point of view, we felt that this total tax contribution report is the final piece that finally puts the whole story together. For decades, we as the banking industry have been diffident insofar as promoting the industry's role and contribution to our country's success. We are by law required to publish our results by a given date. The view that banks' profits are at the expense of societal well-being couldn't be further from the truth.
Said KBS shared value report has understated the industry's tax contribution, and PwC has facilitated in providing an even clearer picture in terms of how banks lead in the area of tax compliance and contribution to the national government.
And I'm very pleased that today, with this PwC report, we can see very clearly how when banks do good, communities do better. Banks operate in a highly regulated environment, and this has led to the high levels of transparency. When transparency levels are elevated, inevitably, the level of tax compliance will be very high, and the relative and absolute quantum of tax paid to the government is also enhanced. And therefore, we as an association are proud to be at the forefront of tax transparency and compliance in the corporate sector. Other findings that you'll see from this PwC assessment include the challenges that the banking sector withstands from a regulatory and tax perspective, as well as within the overall macroeconomic context. Nonetheless, the banking sector is committed to dealing with these challenges in an open and straightforward manner. We therefore hope that this report will enhance our discussions with the various regulatory bodies. At the same time, we believe that KRA has a role to play to advise the government on sustainable tax policies that will ensure that we all contribute to a fair share of tax collection without jeopardizing the private sector growth and innovation.
In 2018, the financial services sector's contribution to GDP growth ranged from 0.1% to 0.2%, having in mind that the sector is not a significant driver of GDP growth. The high corporate tax contribution is also an indication of high levels of regulation and compliance in the industry.
At the end of this, you'll back survey